So I just want to ask the question, what are your conclusions about where people should be investing or where people should be looking going forward? And basically what is no longer working?
Yeah, well, I mean, you and I have had extensive conversations. The catchphrase is like labor versus capital, but and I borrow this from a firm in London that employs this capital cycle investing, where they more so focus on supply than demand. Yeah, I think you want to buy real assets. I do think it's not a knock on tech, for example, but during this financialization period where interest rates have dropped consistently and stimulus has grown, I think obviously technology is going to be a critical part of the future. It's been sort of a golden age if you wanted to emulate these models of attracting traffic and top line growth with minimal worries about earnings or how to fund that growth through your own internal cash flows. And I think so if we're in a regime shift, we've reached toward the end of the secular bond bull market, which by the way doesn't mean that we may not go sideways for years. I'm not convinced that rates are going to be at 10 because for the earlier data, I think that breaks the system. So you'll see repression, you'll see things like yield curve control, but I think the government recognizes that they can't allow like markets to really operate freely. Again, I want to veer away from saying it's doomsday. I think they will. More inflation probably makes sense. That's the surest way to debt monetization. But I think going back to why we would assert that macro is really important. And this again sort of links with how EM has worked more frequently than the US in the past. I think understanding these policy dynamics and policy shifts will be important, whether it's infrastructure programs or how the US goes about reshoring everything from drug APIs, where during COVID we realized that 80 to 90% of our supply of APIs was coming from China, and that seemed pretty irresponsible. And I'm from the Midwest, and I think there's a strong case, as we've discussed, that the Midwest ends up potentially being a big beneficiary in terms of politically, I think, to win swing votes where somebody would want to reshore the votes, and then not to mention the climate change dynamics we've talked about. I think relatedly to macro, thematic investing, which I know you are very involved within, I feel like people's these style boxes or risk assessments of investing, I think that's become a bit archaic. I don't really understand why people are so obsessed with growth versus value. I think thematically you can capture both of those, and you're seeing that right now. But again, thinking about things holistically, where COVID sort of turbocharged the digitization of everything and front loaded a lot of demand. And meanwhile, I saw the stat this morning from one of my analysts, jobs in the oil industry are down by a third since 2019 alone. Whereas actually overall job creation is net positive in the US. So that and behavioral biases like ESG, there's no incentive, but I think that leads you sort of to real assets. And one in particular that we've talked about is water. And again, there's tons of amazing statistics on water, but I feel a bit like it's the boiling frog, and that people see Lake Powell and they see what's happening in the Colorado River, and it feeds so many of these states. And again, I want to make sure I have the statistics right, but fresh water usage is up by 600% globally in the last 100 years. And if you look forward, 70% of these hydrogen electrolyzers, and water is really important for green energy, 70% of those projects will be located in water-stressed areas. Agricultural water withdrawals are going to increase 45% between 2010 and 2030, and we're halfway through. And every week from our friend Drew, I receive a heat map and a drought heat map of Texas and New Mexico, and in Colorado now we have fire warnings today. Once again, like pretty much it's a weekly occurrence. So I think looking for places that have water, there's the demand for water only continues to increase, and yet globally, and again, we've seen this in a lot of the EM countries where literally people are deprived of water and there isn't the infrastructure. So I think, looking at those assets, I think new energy and green tech will, continue to coexist because it's an issue that we absolutely have to resolve. And then I guess lastly, I would mention that volatility, I think we've become used to volatility volatility has been suppressed in tandem with interest rates and sort of this great financialization of the last 40 years. I think that's contributed. I think investors are going to have wake up calls with this notion that passive investing is that they're just going to focus on saving 10 basis points in fees because passive investments, of course, will outperform in an era where the central bankers ensure that asset prices do nothing but go up, especially on a risk adjusted basis. But that's worrisome to me. I mean, Vanguard, I think Vanguard owns over 5% float in 100% of the S&P 500 stocks. And so I think we've created systemic risks there as well, which and you've also done that at the same time. We've minimized the depth of liquidity because of policies that came out of 0809, where there's far fewer prop desks and banks that can provide liquidity when periods are strained. So I think that, and then lastly, I'd say the demographics we've talked about a bit. So I think having a view on how that demographic shift, which to me appears pretty significant and dynamic in the next 5 to 15 years, how that's going to play out is, I think, really important if you want to have an investment strategy. Globalization, I think, is going in reverse. So whether it's infrastructure or other ways to play reshoring, I think we're clearly moving into an era of regionalism as opposed to globalism. And it's not, I don't think globalization is completely finished, but our view is there's going to be more of a China-centric sphere and a U.S. North American continent-oriented sphere as well. And for better or probably for worse, tying in with those themes, I think defense spending is structurally going to move higher. And I think that's both traditional defense, and you and I had this conversation last year, which I wish we could have acted on, where I was trying to figure out ways to isolate just the actual defense companies and remove the commercial airline companies from the ETFs. But also, I think areas like cybersecurity will continue to be important as well. So I think it's, again, the thing I want to make sure I'm emphasizing is it's not like the end of the world, but I think the crux, if I just summarize everything, I think 40 years of policy distortions and manipulation have created an investment environment that psychologically and behaviorally, it's just really hard to understand how much we take these like inputs and variables for granted. And I think what it comes down to is whether you own certain growth equities, technology companies, venture capital, PE, real estate, people are extraordinarily exposed to long duration assets. And the correlations I'm sure they're seeing in the last 6 months, as happens in all markets when things break, the correlation is sort of one. So I would encourage people to diversify or hedge themselves some way, if you agree with sort of the conclusions here. And then two, I just think, finally, if you think about that globalization, just how you want to interact, invest locally, invest globally. And I think when you think about, I don't mean that just countries, but I think in terms of the politics as well, if you are a real estate investor, and if you agree with, I guess, my views of the political transition, I think increasingly there needs to be an awareness of the political orientation of parties in certain states or municipalities. And you could speak this better than I could, but in California, I think you're seeing this, where I'm talking to commercial real estate and other real estate investors who are moving out of the state, either because essentially they're sort of being penalized, partly because there is this sort of populist shift, whereas obviously Florida has been boom times because they've ostensibly taken the opposite tack. So I think there's going to be more of sort of that. And what we've witnessed in emerging markets, where it's this, you really have to understand like the granular politics. I think you're going to see that's kind of in the theater coming to you. And I think the last thing I would just mention is, and I'm not in the camp of, hey, the dollar's days are done, but you mentioned this earlier. And I think if you look at the policies needed to resolve a lot of these issues, and in my view, our politicians always take the easiest way out. I think if push comes to shove, sacrificing the US dollar, debasing the dollar, that's a trade-off that the majority of people would happily take. And I think if you think about the voting population as well, whereas you mentioned earlier, I really don't think that 80% of the country has a significant international, investment presence. So, while we're seeing maybe the impact on exports and, the supply chain issues, I think if the US can do things like make ourselves self-sufficient in energy relative to the rest of the world, or somehow harness what for now is a is a large advantage in fresh water. Yeah, I think the currency is an easy release valve that we can use to I would generate sort of a quasi EM solution to the problem. But yeah, so I'll stop there.